Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be focusing on the commodities as we are chatting with Jordan Roy-Byrne. We're going to talk about this general rollover that we have seen in almost all the metals, while gold is still holding up better than a lot of the different metals we'll talk about, like silver, copper, even some of the energy commodities. And we'll get into some of the companies, or at least the types of companies that Jordan's looking at and the characteristics within those. Jordan is the founder and editor of the Daily Gold. Now, Jordan, first and foremost, commodities. They've lost their upward momentum that, in all fairness, was pretty strong for the last 3 months. But the question is right now, how are you viewing this loss of momentum and general rollover? It doesn't seem like any of the charts there's been major breakdowns, but hey, again, momentum has waned. It's been lost in a number of these commodities. How do you view the overall commodity sector now that, well, it's not just moving higher almost week after week like we saw?
Yeah, hey Corey, I think it could be a signal of declining economic growth and signal of a coming recession. But I say could be because I'm looking at the yield curve and that's not steepening. I mean, it could start steepening at some point towards and through zero, which is a recession signal. But I just pulled that up before we started talking. And, that again, that's not steepening. So I don't know if we can read too much into this move lower in commodities. Oil, I don't know how much of that is weakening economy versus the government trying to get the price down before an election. That always seems to happen. Copper, I would say, put in a failed breakout. If you look on the monthly chart, like that's a really ugly candle. So I definitely would be more concerned about copper. I mean, especially if we are headed for a recession, with which it looks like it's probably going to happen in the next 9 months, maybe. But I think I said the same thing a year ago and 2 years ago. So we'll see how that pans out. Gold in real terms is outperforming, which as a gold bug and gold investor, that's always good to see. So it remains to be seen if this will lead to anything. But certainly if the market is going to digest lower growth and that could lead to digesting a recession at some point, you're going to see gold outperform in real terms. And so in that scenario, I would be skeptical or at least bearish on oil and copper, which are weakening to this point.
Well, Jordan, just to that point, like we were discussing before the call, when you look at the gold to oil chart, gold to commodities, gold to copper, gold has been outperforming by simply going sideways. But isn't it because it's also a monetary metal? It's not really tied to the economy like those industrial commodities are. So in a scenario where you do see a recession and where those other commodities like oil and copper do have to digest a contraction in the economy, a lot of people think gold would get sucked right down with everything. Maybe outline the thesis as to why it could diverge to the upside.
Well, if you think about the points when gold diverged from the economy in the stock market, one time was during stagflation in the 70s, most notably from 1972 to 1978. You had gold was negatively correlated to the stock market. Then you also had the same thing from late 2000 through 2002. And interestingly, those 2 points were the beginning of secular moves in precious metals. And also when I look at my gold against 60-40 total return chart, the confirmation signals that we got were in 1972 and 2002. So those confirmation signals of gold basically overtaking the conventional portfolio, when that occurred cyclically, at the same time or around that time, gold was diverging from the stock market in the economy. So, and looking at that chart, we're coming very close to that point where I think when we have the next leg up in gold, we could get that confirmation signal when it really breaks out against the 60-40. So that is likely to coincide with maybe the Fed having to cut rates because the economy is rolling over. The other point to make is when we got those signals again in 1972, 2002, you're coming out of a secular bear for precious metals, and money was not, I mean, the early 70s, that was a little different, of course, because we're coming off the gold standard. But if you think about the early 2000s, money It was invested in tech stock. It was invested in all these other things. So there weren't that many people buying precious metals. So if you look at these charts of how much money is in precious metals, PM ETFs versus all ETFs, and you look at that now compared to 2008, it's much, much lower. 2008, we had 7 straight years of all this money going into precious metals. And I think there's, people in general have a recency bias, and there's a very strong recency bias with what happened in the COVID crash in 2008, that people just assume that you're automatically going to get this sell-off in precious metals, and then they'll go up after the fact. So I know it's kind of like a weak argument where people will say, well, everybody is saying this. And so, I mean, there's no way to quantify that, but I have 95% of the people I encounter, it's like a knee-jerk reaction where they just assume that's going to happen with precious metals. And again, because of those reasons, because of the nature of these secular trends, and because of the fact that not that money has moved in to precious metals versus all these other spaces, most notably stocks. So there's not huge selling that's going to come from that area like it did in 2008. So I have very little worry about that, that's going to take precious metals down like 2008. I sense it's going to be the opposite, where the Fed's going to have to cut rates because the economy's rolling over and there's probably some stagflation with it. And, those rate cuts are going to be really bullish for precious metals, precisely because you're going to have people moving out of the stock market and out of equities and into gold. And that's really going to light a fire under the gold market and take gold to 4,000 and 5,000. If we get the rollover in the stock market over the next couple of years. So if people have to be careful. I mean, they really should be careful about getting too cute and thinking like, oh, a recession might be coming. I got to sell everything. I'll try and buy it back. You just have to calmly assess what's going on, look at the price action, understand the things you own. I mean, if you're worried about a big sell-off like that, you want to own more gold than silver companies, I would say, and then you want to err on the side of quality companies. Because if you're worried about that, you own a bunch of exploration juniors and optionality plays, that's not the way to go. The way to go is for more higher quality juniors than, buying the riskiest stuff if you're worried about that kind of event.
So, Jordan, I find this so interesting because you look at how gold is trading simply to the S&P, and it's been trading kind of at a lower level, a lower range since 2022, back to levels that really we didn't see we saw in 2008, 2007, 2006. So you do see at some point here where the S&P finally drops and that money rotates into gold and we get this almost revaluation? Or are you worried that this is kind of the range that gold trades in historically against the S&P outside of that 2008 to 2012 run?
Well, I think if you're going to tell me that the economy's not going to roll over for another year or two, then yes, it could remain in this range, as you say. But if you look at where the money has gone, where the capital invested has gone, you look at the gold ETFs, investors really haven't been buying gold. I mean, particularly Western investors. And so if this thing breaks and we're moving into a recession and a downturn in the stock market, yes, some of that money will go into bonds as rates are going lower. But at the same time, some of that money is going to move out of stocks and into gold. And you'll see the gold to S&P 500 ratio really shoot higher. And if you think about the technical setup in gold, we're in the early stages of this cup and handle breakout, where we move from 2,100 to about 2,450, and maybe we're moving back a little bit. Who knows? Maybe it'll come back to 2,150 and do a retest, nearly a full retest. It just giving it a 50,000 foot view, like we are still really early in this huge breakout. But I think for gold to turn higher again, get to 2,700, 3,000, 4,000, 5,000, you really need weakness of the stock market and the economy. You need some capital from the stock market and equities, which everybody owns. You need some of that capital coming out and going into gold. And so that's the fuel that's going to make it move much, much higher.
Well, Jordan, let's circle back to the gold equities, the silver equities. You made an important statement there just a moment ago that you really don't want to be in optionality plays or the riskier exploration drill plays in that kind of a scenario. You want to be in the quality companies. We've talked in the past that you really have a tendency to be in the growth-oriented producers and some of the most solid development stage companies. And it's because they've got ounces in the ground and they can immediately monetize the metals. But maybe just put a little more color on that for investors that may be all piled into only drill plays right now.
Yeah. Well, the first thing I would say is you really have to know the companies and really understand what you're investing in. And too many people and investors, they spend more time listening to macro podcasts, which is not a bad thing. I mean, they should spend a lot of time listening to all the podcasts on the KE report, but you need to spend more time than that really analyzing and understanding the companies that you own. And I've been guilty of that to some degree in the past. And you look at some of the most successful investors, I mean, they're not spending that much time trying to predict the macro. Like they're really focused on analyzing companies and doing company analysis. And I just tend to prefer the growth-oriented producers. They're easier for me to value. I'm not gambling on drill holes. I think at this point, there's still a lot of value in these names. Now, at some point, if we get to later this year, if we get to 2,700 gold, 2,900 gold, then at that point, the exploration companies might offer, compared to the growth-oriented producers and developers, they might offer more compelling value at that point. But here and now, I just think that the growth-oriented producers and some developers, especially the ones that are easy to value and the ones that look like they're 2 or 3 years away from a mine, those are in my wheelhouse, so to speak. I mean, I can value those. I can understand what the potential is. I can think about what are the costs to, build their project or grow production. How much are they cash flowing per ounce? If gold is trading at 3,500 or 3,000, what might it be worth? What if at these metals prices, what will it be worth in a year or two? And by the way, that's how you calculate value. You can look at the current metals prices and assess, like in a year or two, how much might this company be worth. So with growth-oriented producers and some developers where they might have an economic study, you can assess the value much more accurately than, while I own this exploration company, it's really cheap, it has 1 million ounces, but maybe it'll get to 3 or 4 million ounces. I mean, that's fine. I mean, I'm not saying don't buy those. I'm just saying, for me, I prefer the other companies that are a lot easier to value. If you favor exploration companies more and you like following those companies, there's still really good value that can be found there. I actually, in my premium update, I had a table of exploration optionality companies, and there's still some really good value there. So I wouldn't cast all that aside. But if you're looking at the explorers, the real key is, can I find something small that can get to 3 plus 4 million ounces, that type of thing? Because this is the other thing, like size is really important in this market. I mean, size matters. But because of cost inflation, just think about how much more expensive it is to build these projects, and the cash costs are higher. So that really hurts the smaller projects. If maybe have 1.5 million, 2 million ounces, that was worth a lot more 5 years ago. Now, cost inflation has really killed the value of those projects, because maybe 5 years ago you could build it for 100, 150 million. Maybe it's 200, 225 million now. And so you don't have the extra ounces or enough ounces to really give you the leverage that higher metals prices can give you. So that's another thing in looking at these small companies, is they need to show me, how can you get a 3 or 4 million ounce deposit? And because if they have no chance of that, and these are just 1 million, 2 million ounce like the big money, the smart money in the industry is not going to buy those. I mean, a lot of times when you might see these great stories and the exploration stocks, maybe they have a following, but they're not performing that well, it's probably not big enough. Like that's a big flaw with a lot of these companies. So if you're going to go into that space, make sure you find things that can get to that 3 or 4 million ounce threshold, because otherwise the big money in this space is not going to buy it.
And you do need to follow the big money in this space, because that is what moves some of these stocks. But I do want to circle around to those near-term producers, like you said, 2-3 years out, where you can value them based on their economics and their ounces in the ground. But Jordan, what kind of a discount do you put in, and how do you go about analyzing the funding risk around them? How do you view CapEx? How do you view how companies are going to raise that money compared to their market cap?
Yeah, Corey, that's a really good question. I don't have a direct answer for you, but I would say that if there is some question as to how they can raise the money, then the stock price will really struggle. And it's something I would avoid. I mean, I don't like to give away company names, but I will give one example, like Montage Gold. That's something like a while ago. I thought like, they're never going to be able to fund this, or therefore it's not going to get built. When they indicated, I mean, they have a new management team. When the old management team, which has a super strong track record, when they indicated that they were going to be able to finance this, I got really interested in it. My memory isn't that great, but like the point is, that's an example of a company that maybe if you looked at it before, you thought, oh, this is 700 million CapEx. This is never going to be able to get financed. But when the management team really indicated with confidence, and they have a track record at the same time, that they're going to be able to raise the capital to finance it, the stock really, in my opinion, I think it started to move a little bit higher at that point, and then it caught fire, of course, as the gold bull market started. But that's a good example, because that's something it's a really good project, big project, low execution risk, does have big optionality in the gold bull market. But the funding risk was so huge that the stock didn't do anything for a really long time. And so that just shows you the difference. If a developer is really struggling, maybe the project economics are not that great, or maybe just the CapEx is too high. So to get back to your question, another thing is the quality of the project. Like if the project is quality enough, they're going to be able to finance it. Like even if they have a tiny market cap and the CapEx is really high, like in that scenario, the economics have to be really good. I mean, if the economics are not, they're just marginal, the stock is never going to move anywhere because people aren't going to finance it. So that's what it really comes down to. You have to look at the economics and really assess, is this a good project? If they need 2,500 gold for the IRR to be 20%, like that's never going to get financed. If they have a 20% IRR at 1,700, that, given where the market is now, that's probably something that could get financed. So it really comes down to, is it a good enough project to finance? Then it will get financed. But we talked about it a week or two ago. A lot of these projects, if the stock isn't doing that great and there's too much money to raise, they're just going to become orphans because the projects are not quality enough for the industry to finance.
Yeah, Jordan, some interesting points there. And with Montage, I think there's two things that also gave them an edge on other developer companies. And that is, one, they bought some land that gives them a new area to bring to the front of the mine plan that's closer to surface, higher grade, improves the economics. And the big thing why it really spiked was that the Lundin Group came in, the Lundin family mining legends, and put a strategic stake in it. So do you look and filter some of these projects for companies that have a strategic partner, either a manufacturer, a big mining company, or an activist investor? And what are your thoughts on them bringing in a stream on a non-core metal or some other non-traditional way to try to fund it, getting grants, things like that? How much of that factors into the research you do when you look at developers?
Yeah, I would say the strategic, I mean, that helps, but I think, and I'm not saying I know better than strategic investors, but I think I have enough experience and contacts that I can assess, is this a quality project or not? I don't need to wait for a big name to get involved, so to speak. And the Lundins are really good. I mean, they have a really good track record, but there's lots of other strategics where, I mean, major companies have been strategic investors and they've had some shitty investments over the years. So I'm not trying to put them down. I'm just saying we can't like base everything on what they do, but it certainly helps when a company gets a strategic investor. One way that helps is then when they help finance the company, like they're not going to sell their shares. So that's a huge positive. You don't really see the negative of that dilution. As far as streaming or royalty, I just think because we're coming out of a secular bear and it's been a really tough time for juniors, the ones that are still around, I mean, their share structures are just, they look awful compared to 10, 20 years ago when I started investing in this industry. Like I remember 180 million shares was like, wow, that's terrible. Like they have way too many shares. Now that would be really good. So there's some inflation for you, by the way. But the point I was trying to make is, yeah, I mean, for a lot of these juniors, I just can't see them being able to fund these projects without the royalty component. I mean, just because the share prices are in a lot of these cases are just, they're not high enough. So the royalty component definitely has to be a component. Although, I mean, I'm not going to say another company name, but there's a company I'm thinking about where its CapEx is going to be below 200 million and they're going to be able to fund it with cash and debt. I mean, that's another example. Or I'd say that's one of the only examples where they're probably not using a stream or royalty. But again, at the end of the day, it comes back to the quality of the project. Quality projects, now that we're in a bull market, they're definitely going to get financed. So you have to be careful and you really have to know what you're doing when you're looking at these projects, thinking like, oh, well, my spreadsheet here, like Brent Cook talks about this, where it's just because the spreadsheet says, well, at 2,500 gold, this has a 23% IRR. At 3,000 gold, they're definitely going to build this. Like, that's not how it works. So, at the end of the day, look for quality projects, look for value, because the quality projects are going to get financed. And the other thing I look for with developers, I know that I'm rambling on here, but the last thing is, I like the ones where it's a quality project, it's going to get financed and built, but the valuation is pretty low. So therefore, they can get a huge bump when they actually build the project versus, I mean, if it's a project where it already has a high valuation, the stock price is done really well, and then it's like getting built, I'm less interested in that case because it's just a common sense thing. The stock's already made a big gain. I'm taking on the execution risk versus I'm looking at something where the valuation, the market cap to NPV or NAV, like if it's really low and everything looks good, low execution risk, then when they successfully build it, like you're going to get a much bigger re-rating in that case.
All right, Jordan, we'll wrap it up here. Good comments on the stocks. And again, it continues to be a game where you can't just go in there, close your eyes, and buy everything indiscriminately. Even though we have seen a lot of stocks rebound over these last 3 months, some of those stocks have also started to give it back. We can really see some of those higher quality companies that are holding on to some of the gains and some that are continuing their uptrends. But we can definitely tell that it's not all those companies. We are not in that environment where a rising tide is consistently lifting all boats, but I think that also just shows that we need another leg higher in these underlying metals prices, which, as we said on the onset, have waned a little bit in their upward momentum. Jordan, thank you as always for your time. We will post a link to the Daily Gold below this interview and in the show notes. Everyone, be sure to visit Jordan's site, and we'll follow up with Jordan in the next couple weeks. Thanks for your time, Jordan.